All right. Let's see how far the lag goes. It says we are live, Dion, but I do not see it yet on my phone. We are just testing out StreamYard instead of Zoom. Oh, we've got some check marks now for both of us.
And we're live on YouTube.
There we go. We're live on YouTube. Dion, dude, I appreciate you doing this. You know, I don't do a lot of things on Saturdays, but I just invested in a new application called StreamYard. So I wanted to see how it worked, and I thought it'd be easiest to do it with a friend. So thank you for being here.
No, I look forward to it. I really like live streams. Right? So I like watching your daily update and everything, and you kind of see the chat. But these live streams is where people can ask questions, where they can see what matters to an investor, what we keep in top of mind awareness. Like if we get a question and we think, oh, that's a good question, I have to do some research or contact somebody. That's not something we had to like keep in our minds to make quick decisions in investing and working towards financial freedom. But when we have an answer, when it sounds like we have like a scripted video we can answer, it means that's come up a lot. We've had to deal with it on a daily basis, and that's what you're going to need to know as a new investor.
Yeah. Again, folks, this is for you. We can see all of your comments here. So if you want to prompt us with some questions, just go ahead and put it in the comments, and we will do our best to get to them. Good morning, good morning, good morning. You all are amazing. Thank you for being here Saturday morning. We will go for about an hour. I wanted to check out StreamYard because I think StreamYard is far more powerful than Zoom. If this works, and it feels like it is working, I might even be using StreamYard for my daily financial news. I could bring in articles and things of that nature. I haven't figured out all the bells and whistles. Like I'm not sure how to share a spreadsheet yet. Looks like I can share web pages pretty easily, but not spreadsheets. So lots of stuff for me to learn. I'm not great at this, but given that I don't see really any questions to jump into just yet, I know there's one question I get all the time, Dion, that you and I simply attack differently. And that is during our growth stage. So for you, maybe that was year 1 through 8. For me, maybe that was year 1 through 10. I purposefully decided to leverage equity and do what's called cash out refis and or 1031s. And you decided to do frankly, the complete opposite and just, save, use the snowball, right? So savings got quicker, but you never, as far as I know, never leveraged equity during your journey. So I think we should talk about that. A lot of people thinking about, hey, should I use it? How should I not? What are the ups and the downs? So why don't you talk about your decision, at least to date, never to leverage equity?
So one thing that's really important to me is trying to understand that we make the decision based on the information we have at the time, right? This is something like it's a carry forward from when I was working in law enforcement, right? An officer is allowed to make a decision based on what they knew then, even if we find out something later that changed the entire scenario. So real estate's the same way. Looking at it now, I can absolutely say that recycling capital, the way you did, the way the lumberjack landlord did, the way Millennial Mike is, the way Michelle Meyer is, right, with their 1031, ends up with a bigger portfolio with bigger cash flow in further down the line. It's a much bigger thing. My goal was the right amount of cash flow from the least amount of units. So since my goal didn't align with I want a bigger portfolio and bigger cash flow, it's not the way that I went, because the way I see it, and you have the econ degree, so you can correct my monkey brain if I'm wrong. But when you recycle capital, right, you're not using your equity, you're not tapping your equity, you're adding debt to an existing asset. Your HELOC, your cash out refi, whatever it is, at 1031, you're losing the asset in that case. So when you add debt to an existing asset, even if the new deal might improve your income, you are narrowing your margins on the existing asset. Correct. So much so that on Norris Drive, you inverted it.
I did.
You turned it into a loss. So I am absolutely the first one to admit it'll be bigger. It'll have more cash flow if you recycle capital.
Well, you know what? Let me push it that a little bit, because I have the unfair advantage knowing that I was going to ask you this question. So you and I are boys, so I kind of knew where you were going to go with the answer. But I just want to poke at that a little bit, because again, I think what you did was obviously very purposeful. You had a stated goal, which I think is great. I just want to offer up a counter that could have gotten you to the same point, meaning the most cash flow with the least amount of units. It just would have taken maybe a different route. So let me just lay this out for you. Again, if your goal was to be done with, say, 15, 16, 17 units, During your growth phase, one thing, again, you could have done was, again, leverage up the debt, right? Pull equity extraction to add the next asset, instead of maybe having, I don't know, 15 or 12 or whatever it was when you retired, maybe you had 30. To your point, right? You're getting a bigger portfolio, but it's not your goal. But I offer a thought. If at that point you get ready to retire, maybe the last year, you could sell down that portfolio, use that equity extraction, and perhaps pay some stuff off. I just want to offer that up as a counter perspective, as something that could have been done maybe if you had thought about it.
No, it's a great strategy. It's actually what Cody Davis, who's in the chat and just did a super chat. Thank you, Cody, for that.
Oh, look at him. Hey, Cody.
Yeah. So Cody built a massive portfolio with really creative strategies, contacting owners, doing the seller finance, right? Starting having 30 units before he could buy a beer, and then having over hundreds now.
That is respect, Cody.
Which is factual. And now he's right sizing. He's divesting himself of some partnerships and taking that equity and doing other things with it. And so he's right sizing his portfolio to have it. But let's take it one step further. Right? So we're on a logic chain of why yours worked for you and why mine worked for me. So I admitted yours would have been more cash flow, bigger portfolio that I could have then right-sized and had even more cash flow. Working full-time, raising 3 kids, single parent. I can do a transaction every 2 years to start, then every year and a half, versus if I recycled cash flow, I absolutely would have had that dopamine hit of, I did 3 or 4 deals this year. And I can't stand it. It's taking so much of my time, and I'm doing rehabs and repairs and tenant turnovers. And I wanted long-term tenants, kind of where the binder strategy came from, right? Happy tenants don't leave. Happy tenants don't trash your property, and they stay longer. So, so that it's more strata to my goal, right? Would have happened with your strategy of recycling and cash flow, but my resources, my time, my lazy nature of, if I focus on work and I focus on raising the kids and I just do this real estate on the side, in 5 to 10 years, the real estate on the side will become such a monster that I don't need the work. And so you're absolutely right. Recycling cash flow is faster. I think it narrows margins and it gives you more transactions. So if you're like Millennial Mike, right, and he's in that millennial bracket, that's where he's from and where he is, that 2 or 3 deals a year or every couple of months probably feeds him and gives him energy. To me, it was like, I bought 1 property and I've talked to 2 tenants. I'm done for at least a year. Don't nobody talk about
nobody bother me.
Right. Yeah.
Yeah. It's really interesting to think about it. Again, we both have the vision of hindsight. You were definitely more purposeful in your journey, right? You stated from the very beginning, right? Most cash flow, least amount of units. I got to tell you, dude, I wasn't even thinking about financial freedom until like year 7 or 8. My goal was very much, just have a better retirement, right? I was just trying to be in a better spot at 65, let alone being done at 45. And maybe I was just too focused. I mean, again, I have a unique skill set to just like laser focus, and I simply don't see anything else. It's like a tunnel vision. I think of it like being on an airplane, right? Where you can just see ahead of you and like nothing else matters, right? It's just visual. But I definitely think it is something that if you're going to extract capital, i.e. cash out refis, 1031s, whatever, please have a plan. Don't just do it. Don't do it because you're looking at return on equity, and return on equity is low. That's not the right strategy, in my opinion. Have a plan.
So I have a whiteboard here. I won't do it today. I won't put people through it because I would like to have some numbers in my head ahead of time. Of my cash on cash return now is, I want to say like tenfold. So it's not even like a percentage base. But cash on equity, it would be terrible with my strategy. It looks really, really bad. Yep. But I'm okay with that.
Yeah, that's the thing. I think a lot of people they get introduced to a new concept, return on equity, right? And they never thought about it before because they live on cash flow, right? Or maybe they look at their net worth, and then they go, "Oh my God, my ROE is horrible." Compared to what? I mean, why does that matter? I mean, sometimes we try to bring over stock-based formulas and lingo, and it distorts our real estate portfolio. So yeah, I don't look at return on equity. I never have. I mean, I have because people brought it up, but I think return on equity is it can send you down the wrong path.
Yeah, I think it takes away peace of mind. It takes away stability if you're chasing that number without finding the balance that works for you. There is a super chat here from Steven.
Yeah, I just see that now.
I think that's more of a question for you because I'm not a tax guy. I know that there's good tax benefits and I have a higher pro for it, but
there you go. I will read it for the audience just in case you're not on. It says, I fixed up my rental to sell. Can I 1031 and pay off some of the repairs to minimize capital gains taxes? What would you guys do, refi and or sell? So if you are going to declare a 1031 and it is going to, the money's then going to go into an escrow account, no, all that capital has to deploy it into an asset. You can't use it for expenses. I say this as an accountant, somebody who's done a dozen or more 1031s. That said, you could, again, if this is something you wanted to do, and I would do this before, so you may, if it's on the market, he said, right? Yeah, so I would probably do this before it was on the market. So let's say, you have an asset, $500,000, you got $200K in debt, you have $300K in equity, but you got $100K in repairs you want to pay back. What I would do is I would go get an equity loan for $100,000. That way it's debt. Then I would pay off the repairs. Then I would go to sell it. I would leave the debt there. Then when I go to 1031, it's paying off debt, because when it goes, the proceeds go to this escrow account. All debts paid off first, not expenses. It's debt, as far as I understand. So that's how I would get around that. As for would I refi and or sell, if you want to sell it, that's where you're at. But I think what you're saying is go get a second. Basically, you're adding more debt on the asset, and then that debt pays off the repairs. That's how I kind of see that playing out. Does it make sense, Dion, logically?
It does. I would break it down and look at the cost of capital. What does refinancing cost? What am I looking at there for the expense? And then when you go to sell, you take care of the debt, and then the capital gains is your basis plus minus your debt, right? You have what's left up there. Before you do that, when you do repairs, those repairs can be used against your passive income. So if it was a rental in this amount of time, and if you had rental income that year, it would count there too. So those repairs it's not like you're just spending the money and you lost that money and it's not a write-off. It can also be a write-off. I'm not a fan of selling, so I could go down the logic saying, well, how do we get to selling first?
Yeah. So it's funny. So obviously I've sold a couple of things in my day. Anytime I think there's like I sell when my single family homes are at their peak. I did that once, obviously very successfully, and whenever that was, 9, 10, whenever. And I'll do it again. I want people to realize if the market plays out like I think it will, which is where single family homes, especially the stuff I buy and I own, entry level stuff, stays solid, or heaven forbid goes up because of some external government intervention. I mean, one of my biggest fears is they create some more free money out of thin air, which is never free. Oh, by the way, it's our tax money and it's inflationary. Never forget that. But let's just say they do that, and I happen to own 37 single family homes, and they suddenly make my 37 single family homes worth an extra 25% over 2 years. I have no problem selling every single 37 single family homes. I will probably 1031 20 of them and then keep the cash from the other 17. I'm just at a different stage of life. I don't need to do all of them like I did last time. And then I would move into distressed assets, because I know with certainty Class B and Class C multifamily has the same pain coming that's currently being absorbed in Class A, right? Class A, Blackstone. I don't know if you guys saw this. Blackstone reported earnings Thursday. Jonathan Gray, one of the 4 guys I put on my Mount Rushmore of real estate investors, right? He's one of those 4. They called the bottom in commercial. Now, again, you got to remember what they buy. They buy Class A. He was right. The Class A is already going up, but I believe Class B and Class C have not been retrading yet, and that's what we're waiting for. So I fear that the dominoes are going to play out where Olivia and I's portfolio goes to 400 units. I mean, that's not my goal, but I mean, if you're going to go throw free money at me, I'll take it. It's crazy.
Here's a fundamental difference between us, and I kind of am having this realization during this conversation. So if as the value of your single family houses goes up because of market conditions, there's a point where you go, yep, totally makes sense. I'm gonna sell. I'm gonna 1031. I'm gonna turn 8 into 80 or whatever that
Right.
happened last time. You'll
Yep.
agree with that. I think it's inversely proportionate to me that the more value my paid off single family house is, let's say, because I have the one, let's say I had more, I have properties too that are worth more. The value goes up, the less likely I am to sell.
Let's poke at that. Let's poke at that. So why? So let's answer why I would sell. Because I love your saying, and I'm becoming more comfortable saying it myself. If you won the game, stop playing. Right? You said that. At least the first time I really heard it was like 6 weeks ago, and I'm like, that son of a gun. He just changed me forever, right? But I'm just so naturally wired that, because let's be clear, if my 37 single family homes go up 20 or 25% in 18 months just to split the difference, I think they're going to be overvalued, and probably overvalued by a significant amount. And I don't want to hold those, even though it won't hurt me, through a 25% down cycle. One of the things about California real estate is it has cycles, right? Not like some markets that are like this. California real estate goes like this. And I refuse to ride one of these out if I don't have to. I just can't. I fundamentally don't want 200 more units, but I also don't want 37 homes to be worth 30% less 4 years from now, 5 years from now.
See, and this is where I think Matt was going to have an aneurysm. Let me break down the math on this. So I have a single family house that's paid off. It's worth about $450,000. Right. So cost of selling, capital gains, I'd probably have around $300,000, maybe a little less in my pocket if I sold it and walked away. If someone came and said, I'll give you $1 million for your house, cash, no appraisal, no contingencies, no nothing, just $1 million for your house. To me, that means the place is now worth $1 million. Somebody's willing to pay for it. But property is worth what someone's willing to pay. So there's some value there that's worth $1 million.
There's at least one person that thinks it's worth $1 million. Correct.
It's giving me, right, it's rented to a Section 8 tenant, $3,000 a month. Talked to her twice in 2 years, right? It wasn't even at lease re-signing. We didn't even communicate for that. That was just in emails back and forth. It's a dialed-in tenant. I don't think about it. It gives me the financial freedom to do everything I want every day. Versus if I sold it and I had the $1 million, now I've got to go find a deal. I've got to put the money to work. I've got to maybe use more leverage, take the $1 million, turn it into $4 million in portfolio assets. Once you've won the game, I don't know that there's a number. I mean, if somebody came with something stupid and starts talking billions, of course, everything's got a price.
Yeah.
But an actual real value, if it's worth 450 and it goes up to 6 or 7, I still don't see me selling it, because it isn't about the cash on equity. It isn't about redeploying the funds. It's about, so there's a superpower. I'm doing a video later today. The superpower of financial independence, financial freedom. It isn't time freedom. It isn't options. And it isn't peace of mind. When I make this video, I'm going to have to whiteboard, because it's so simple on the actual power of financial freedom that comes from not even selling a property if somebody offered me a stupid price.
You're right. I think you just had an aneurysm. By the way, Matt the Lumberjack, I tried to invite you, but given my window's already open, I apparently can't. Again, maybe there's a way in StreamYard to do it. I have no idea. I tried to invite him. It couldn't. Gave me some silly warning. But I'm sorry. I didn't invite you. Again, put in your questions. Love to get some more questions from folks. Do you see any in there that you want to?
I do. I saw one earlier. I'll just read this. Dennis said, I have an interested tenant that would like to go month to month so they can learn the area. They also want to install a new step and railing for one of the older relatives that will be living with them. What questions should I ask? What should I be aware of in your opinion?
Yeah. So again, I would, if my standard is, and I would think all of us have the same standard, is a year lease up front, if not 2 years, I would not go. I would just decline that application and move on. I don't sign up for one, because just think about it. You got to remember what kills landlords. It's turnover. So if you're going to sign up for someone that has a very good chance of moving, it would be a no, and I would move on immediately. As for the other half of that question, I would want to know if they're skilled, right? Are they a contractor? Are they going to have a contractor do it? Is it going to be the code? Because basically what, could happen is they could do some hack, and then that person they created it for gets hurt. You're the owner, right? You're in trouble for that. So again, unless they're going to be paying a licensed contractor to do the modifications, which then I could hold the contractor liable for. No, I wouldn't allow them to do that either.
So here's how I've handled similar situations. I don't know that I would sign a lease with somebody expecting to move out. I'm with you on that. There's enough demand from other people to pick a tenant that's going to be there long term. However, when I'm signing the lease with my tenants, one of my conversations is I tell each tenant, you shouldn't be renting. We shouldn't be signing a lease. You should be buying a duplex like this, living in one side, renting out the other, improving your financial future. It's very rare. Only 2 people have purchased properties since I've been the landlord, and they didn't buy duplexes, they bought houses. So I have that conversation. But those ones that wanted to buy a house that said, yeah, we really want to buy a house, we're re-signing the lease. But if we sign for a year, what happens if we find the house? So what I did is, we're going to sign a year-long lease. I need a year-long lease to satisfy my lender's requirements of the majority of my tenants having more than 3 months remaining on leases. So month to month doesn't help me. But let's sign a 1-year lease. Just did this last year. Let's sign a 1-year lease with a $50 lease termination fee. So I have the long lease that I need. You can get out of the lease for $50 when you buy your house. Congratulations, you're on the property ladder. We got you there. So that's the way I handle that. Had one where they wanted a ramp put in because they have a niece that comes over that's non-ambulatory and needs the ramp. And I was like, absolutely, but we're going to handle this like a triple net expense, right? I've been a tenant triple net with the CDL school where we were the tenants, wanted upgrades. And they go, sure, we'll do the upgrades. Here's how it impacts the rent. I would say, I'm going to get a quote on the ramp. The ramp's going to cost me this much. I'll break that out over the term of your lease. Your rent will go up by this amount of this expense. If I put the ramp in, absolutely, totally willing to do that. It's above and beyond what we would normally do, but I'm not going to let the tenant do it. And if the tenant were going to hire a contractor, I would be with you and Mike on, are they going to pull a permit? Mm-hmm. Is it going to be to code? Do they guarantee their work? I'm not paying for it unless I can shop quotes. And then so I ended up hiring a contractor, putting in the ramp, adjusted the rent. It was like, I think it was like $35 a month or something, spread out over the year. It was just so we could have it on paper that expense was covered by the tenant. So those are some of the options that you have.
Yeah. So I see a super chat from Stay Winning Podcast talking about Prop 33. This is actually the first time I'm going to say this out loud. I am no longer a California resident, and I don't vote in California. I now vote in Vegas or Nevada. So I can tell you that I did not look at any of the propositions in California this year for the first time. What I would generally say is, does King Gavin Newsom, is he for it? And if he is, I'm against it because he is a socialist through and through. So that would be my very simple thing. I would always figure out what Newsom is for, and I would vote the other way. That's my simple way of handling California propositions.
It's ironic on YouTube. I try to stay kind of in the middle because if you could offend the algorithm, it can kill your channel. And then I watch the Compared to What guy, was it Jason Hartman?
Yeah, Hartman, yeah.
And he goes so hard against socialism and liberalism. And I'm like, his channel's successful, so maybe I'm doing this all wrong. And I should just be a little more transparent on how stupid some of their policies are.
Yeah, I don't play for the algorithm, obviously. I actually still produce too much content for the algorithm, so that never been a concern of mine. But yeah, I've been very clear about Newsom. We went to the same college, so I know of him for 35 years, and he's always been the same rotten. He's a rotten individual, let alone a horrible governor. He's just a bad person.
I have an issue with somebody who would cheat on their spouse. Because that's the person you actually took a physical oath with.
Yeah.
How can you trust that person with anything if they will cheat on their spouse? But there's a question here from Michelle.
Well, one more thing, just because I got to get this out of me or my head's going to explode. The thing that bothers me about him is he broke the bro code. He cheated on his best friend's. He slept with his best friend's wife. Think about that. What kind of rotten individual does that? That's just... Anyways, okay. Question for Michelle. Get me off this.
There you go. As savings accounts percentages start to go lower, when would you start to pay down loan balance if you can't find a good cash flowing next deal?
That's a great question. what I always go back to, and again, you got to remember, I've been doing this a long time. A lot of times when I was during my journey, savings rates were under 1%. So I know what you feel here. It's just a question of, are you in acquisition mode, or are you in growth mode, or maintenance mode? If you're growing, I didn't see any reason to pay off debt. Everything I bought cash flowed. Everything had 30-year debt. It wasn't really a consideration. If you were getting close to being done and you're looking at the numbers and going, if this debt disappeared, this may get me there sooner. I would consider that. Where I'm at now in this story is I've looked at my portfolio, and if I had any debt over 6, I would pay that stuff off. Especially if savings rates went sub 1 again, which they may go sub 1 again, in the next 6 to 9 months. So yeah, if there was a 6-to-1 ratio, like 1% savings, 6% debt, that's where I kind of draw the line. Dion?
So I can actually go through a little bit of a timeline to help Michelle here. In 2015 to 18, we were allowed to have 4 mortgages in our name.
Mm-hmm.
I was not, because I hadn't found one rental at a time yet, right? You wrote your book in 2018.
Mm-hmm.
I didn't know about DSCR loans, asset-based lending, hadn't really, educated myself on. All my loans are conventional. All my properties are from the MLS, right? So I'm just real simple, boring, basic guy.
Mm-hmm.
And so in 2018, I focused and paid off a mortgage, and I've made several videos on how I lost about $1 million on opportunity cost, right? So looking back, because we can only have 4 in our name, I didn't know about the other loans. It was above 6%. It was my smallest loan amount, highest interest rate. It hit Avalanche, it hit Snowball. Information at the time, I don't regret it. It was a mathematical mistake. So I learned from that. And then in 2021, I was looking for a property, and I made several videos on this. This is the weird problem I want everybody to have. I had the income snowball. I still had a job. I retired in 2022. I had $500,000 in cash sitting in the bank. I was looking for that deal, and it kept building up and building up and building up. So Michelle, as your money builds up and your savings isn't giving you a lot, I actually made some videos with Matt where we wanted low savings because we wanted to be motivated to put it to work.
To play out, exactly.
Right. Yeah. And here's what changes, Michelle. Instead of thinking, when do I pay off the debt? Think, how does my strategy possibly change with this increased amount of capital? So I had down payment for the next duplex. It grew, and I was like, okay, I'm going to find my next $1 million fourplex. And then I was thinking, well, that's so much. Maybe I could self-fund a BRRRR. No hard money, no timeline, buy this place, spend the money on the rehab, create $300,000 that just didn't exist last year. Like all these things that happen because your money is growing. It's a terrible problem to have, Michelle. And yes, you're not going to make as much money from savings, but what other options do you have now? Could you build that? You bought the duplex. I went to it myself. We did a live stream in front of it.
Nice.
You've got a section. You could build an ADU in. That would take a serious amount of capital, or the more capital you had, the less you'd have to borrow. That would be hard money or timed money or a construction loan or something like that. So what options open to you as your capital grows?
Yeah, again, I think it's definitely a conversation or something you should map out, because there's a lot of options. But to me, it's always the plan. Are we still in acquisition or growth mode? Are we in or nearing maintenance mode? Because
sorry.
Go ahead.
There's a super chat question from Martin C.
Mm-hmm.
So I'll make sure we get to that before we get to Kyle's question next. But Martin C, do you guys buy real estate options from owners? Do you use that as an investment?
So I have never done that. I've never bought an option. This is about controlling a property. I've never done that. I've certainly researched it a lot over the last several decades. I would always go to TIE, right? The TYLG. If I found an owner where that was an appropriate opportunity, and yeah, I would consider that, like a lease option or something like that. It's certainly a strategy that I am not against using. I just never found a reason to use it. I do think lease options are absolutely a strategy, both as the leasee or the leaseor, if the situation warrants.
I think I love the answer where if somebody asks me, how do you invest out of state? Here's Millennial Mike. How do I, increase the value of my properties with rehabs the best way, most cost-effective way? Here's lumberjack landlord, right? Mm-hmm. Having someone like Ty to go, yeah, that's not something I've looked into. I'm, like I said a few minutes ago, I'm super boring, super basic. All the deals are from the MLS. It's all conventional loans. I wouldn't know where to start researching that, but I would go, here's the person I would start with. And that's why I like about the community is we've got the people like Ty that are doing those things. So if that's something that interests you, find a person who's done it successfully.
Yeah.
And see if it fits you.
And oh, by the way, this is one of the reasons I went to StreamYard. Let me just see if this works. Join school. Look at that banner. So sexy. The reason I put that banner up is Ty has a 6-hour masterclass on creative financing where lease options, land contracts, all of these other more sophisticated options are available. All you have to do is join school. It's usually $500. It is available in school. You do have to get to level 2. It's one of the goodies that's an unlock. So you have to, put in some comments, post, but it's very easy to get to level 2. But yeah, join school, $20. You're going to get that 6-hour masterclass from the one and only TYLG. It is level 2. So join, make some comments, become part of the family. Look at that. Yeah, and I can make it go away. See? That's pretty cool.
Nice. Here is a question from Kyle. I have one property in a market I no longer invest in, 7 rentals total in another market. Taxes and insurance increase so much that it's almost break even after taking out 15%. So should I sell it?
I would. I think in my opinion, what Millennial Mike's doing is absolutely right. If you're going to go out of state, my opinion, one place, one team, right? I think it was Charlie Munger, rest in peace, who said, I think diversification's for idiots or morons or late, whatever. And I agree with them. If you're going to go out of state and watch the basket. In my opinion, you can't watch Cleveland and Huntsville and Richmond or wherever, right? It's just somebody's going to rip you off. And especially if that one outlier is now break even and going the wrong way, I would be out of that son of a gun in a heartbeat, in my opinion.
Can you imagine? I have a contrarian view.
I go hard now because I expect you to have a contrarian.
There you go. Good. I love that it's not an echo chamber, right? You're absolutely right. The focus, and then I'll go like there's people like Frank and Cynthia Contreras, right?
Sure.
Guy REI.
Yep.
They're in several different markets. He's a handyman, a contractor. He's got years of experience. He's in the network, so he's doing good. But here's the difference with Kyle. So you have a property you no longer invest in, which means you did. So you probably have the handyman and contractors. It's about break even. Have you done the binder strategy? You have a tenant turner coming over. What's area average rents versus what was your rent? When your insurance and taxes went up, that's happened everywhere. Have you raised your deductibles? Have you shopped rates? But here's the question it always comes down to for selling, right? Because there's all that when we talk equity, it's do you HELOC, do you cash out, do you do a second? It's how do you tap it? But the most important question, Kyle, is this one. How you answer this question would tell me if you should sell or not. So you own a property in this market that you no longer invest in, and you have 7 in this new market. That property that you have, if the house across the street, the fourplex, the duplex, whatever it is, identical to yours, same layout, exact same parking, same market, same neighborhood and everything, was for sale today for what you paid for the first one. So even though whatever's happened, prices could have gone up, they could have gone down, whatever it is. If you paid 100 and now they're worth 4, whatever it is, if it was for sale for the same price that you paid and you could get a loan on it with the interest rate you have. So if you got it last year and it's 7 or 8%, or if you got it in 2020 and it's 3%, if you could buy the identical property across the street, same price, same interest rate, would you buy it? Because if the answer is, yeah, it was a screaming deal back then, it's just not good now. If there's something there that you would buy for what you paid with the rate you have, why would you sell the one you have instead of thinking, here's how I optimize and strategize to make this increased income in a market I already know because I already used to invest there. So it's not like you have to go out and learn a new one. So I think Mike's right. I stay in one market, and it was going to be a shift. If I was going to go out of state, I was going to stop looking in my market and go to Gary, Indiana with Millennial Mike's coattails and ride his systems and buy rentals there. So for me, it's one market at a time. It's almost like the one rental at a time evolution. It's one market at a time.
No, I think that's absolutely right. The other thing, again, the other thing that I've done in my portfolio, again, kind of in maintenance mode now, is I often look for the property that's causing me the most headaches. Right. About once every 2 years now, we just sold I guess it's not just, I guess it was 2 years ago. We sold a triplex. That was a screaming deal. When we got it, I would buy it again, but it was always that property that it felt like it had a bad juju or something. And it just had to go. It caused 80% of our headaches. Think about a guy who has a portfolio of, nearly 200 where one freaking, triplex is 80% of my stress. Just had to sell it. So the other thing that I think, if you have one property here and 7 elsewhere, if it's the property that's causing you the most headaches, That's another reason. I mean, at some point, you can do better with the capital elsewhere. So something else to think about.
Yeah.
Old,
And Kyle answered the question with, I hate the market, I would get out of it. Then if you wouldn't buy, then you sell. So go ahead. You were going to read.
Yeah, Old Guy REI is with the shout out for the Vegas event. I actually wonder, of all the people watching right now, who's going to the Vegas event? I bet you there's 50 people, maybe 40 people here now that have already bought their tickets. But yeah, guys, we are 123 days away. VIP is nearly sold, or actually it's half, so it's 50% sold out. General admission is only $299. We go for 12 hours day one. 9 hours day two. Again, the session is for this audience. Everybody, all the speakers, we've given you the agenda. The agenda's on Eventbrite. Every speaker is going to have 20 to 25 minutes where they take questions from the audience. Also, the wonderful thing about our community is the speakers don't fly in, fly out. Also, our speakers don't sell anything, right? They're all there to say thank you, to give back, to meet you in real life. I don't think people really understand how special the ORaaT celebration is. And as of this morning, I just checked, we've sold 96 tickets total. We're trying to blow out the room, meaning full capacity at 400. The last thing I'll say is Vegas gets more expensive the closer you get. So buy your tickets today, get your flights and hotels today. You'll actually end up saving money. Vegas is just that weird city that it gets more expensive the closer you come. So folks, buy your tickets. Buy your tickets. If you're coming, leave a chat comment so everybody knows who's coming.
Something I just learned. So I'm booking my tickets to Thailand, and I was going to go to Thailand and then go from Thailand to Vegas to the event and then come home. Mm-hmm. And it's like 3 times the cost to fly from Thailand to Vegas than it is to Thailand to. So I'm going to go to Thailand. I'll probably come back here a couple of days before the event, and then I'll fly from here to Vegas because it's super cheap. Chester has a comment and a question here.
All right.
I'm looking at multifamily next. Now that I have a single family resident under my belt, thank you. Congratulations, Chester. That's awesome.
Congrats.
Does it matter whether I go for a duplex, triplex, or quad, assuming the cash on cash return is comparable?
So again, the first thing that hits me when I get questions like this, and this I get this question versions of this question nearly weekly. And my initial reaction is, dude, you've just figured out single families. If what you bought is actually working like you thought it was, do it again. Why change what is working just because it's new? As somebody who only had single family homes and then suddenly sold a house, bought a 5-plex, let me tell you, it's a different ballgame. It's completely different ballgame. Why make it more? Why add stress? Why add more risk? Why add more errors? Just go do another single family home. There is nothing wrong with getting another single family home. There's no magic in saying I own, a duplex or a triplex. This game is about building cash flow and wealth. So my initial reaction to anybody who asks a version of this question is do it again. Rinse and repeat. That's what I'm thinking.
Yeah. And Chester, the king of overanalyzing. Right? If you're happy and you know what overthink with your spreadsheet and your 50 tabs and everything, with the amount of research you did to get the single family, I don't know that you want to take on changes to the duplex, triplex, or fourplex. If you go, all right, I'm going to set up my search. I'm going to look at houses, duplex, triplex, and fourplex and stay at 4 units or less. The debt stays the same. The tenant turnover is not too much different, right? It's not like jumping into 5 units or more, different loan structures and having a whole new ballgame to learn. If the return is the same, like you're comparable, like how much your yield is the same, there's a couple things to consider. You can have 10 conventional loans in your name, so a fourplex gets you more units. The down payment on a fourplex is going to be more, so more money invested means more money, even though the yield would be the same. But how I would look at it, if you get to the point where, okay, if it's comparable, that's not what you're going to find. You set up an auto search for single family, duplex, triplex, and fourplex. You're not going to get 10 deals that all have a 10% yield, and they're all different sizes.
Now, let's be clear.
Right.
We should be talking about return on time, return on effort. You have figured out singles. Don't add, especially when it's one. Like, please don't. No, you don't need to go backwards.
Especially if you're in a market where single family houses perform. Right?
Yes,
My
they work.
first
They
when I
work.
started here was they worked and they don't work in Washington. So I
Yeah.
didn't buy them. I went with small multi. It was the reason I switched. Wasn't because I preferred them.
Yeah.
So,
Yep. So we got a validation that flights to Vegas get ridiculously expensive. Hotels get ridiculously expensive if you get a month or two out. So guys, over 123 days. Thanks, Franks, for the reminder. Time to start buying your tickets because, yeah, you can actually save money if you buy now. You get everything wired. So it's pretty funny. So I want to read a question from Dale because I think this is important. How do you guys feel about the market in 2025? Then there's a follow-on, but I just want to talk about 2025. I am really, and this happened to me. I mean, if you watch my daily financial news, you guys know this happened to me like Tuesday or Wednesday. I, for the first time, am seriously thinking that we could end up in what's called a no landing. So not hard, not soft, just the economy keeps chugging along. The more and more I think about this, the more and more nervous and excited I get. Let me explain why that is. Which one do we want to do first? Let's do nervous first. The reason I am nervous about a no landing scenario is it just means the pain of a recession, right, is going to be stretched out over a longer term. What might that look like? I think there's a lot of bad debt in the system. I think there's a lot of bad deals in the system. And if we go into a no landing environment, which means rates will be higher, we're not talking sub 6, we're talking mid 6s, right? There was a lot of people that got excited in commercial real estate when the Fed cut 50 basis points because they're like, yeah, my deal got better. No, it didn't. A bad deal is a bad deal. And if we're stuck in the mid 6s all of 2025, that pain's going to come due. And what we're going to see is there will be individuals that, it won't be a wave. It won't be an avalanche. It won't be Wile E. Coyote over a cliff falling like a stone. It'll just be, a cut here, a cut, like just think about paper cuts, dying by 1,000 paper cuts. It's going to be painful to watch. There'll be a lot of individuals that try to hang on, and they're hanging on by their fingernails. And this will be companies. There's lots of companies with bad debt structures. There's a lot of small businesses that are just hanging on. And if we go into this scenario, that the debt structure is going to blow people up. So that's the nerve. And I say this as somebody who was just old. Like, I have a horrible memory. One of my only memories for being a child is the early 80s, where my old man was unemployed for 14 months out of 18. It was horrible. It was horrible. I would never wish that on anyone. But I unfortunately think that's where we might end up in a no landing scenario. There will be some families, through no fault of their own, or maybe some fault, that if you get laid off, it's going to be tough to find a job, right? That's what that environment was. Because in the early 80s, if you had a job, you were kind of okay, right? It was where I think Warren Buffett said for the first time, a depression is where you're laid off and a recession is where your neighbor's laid off. So again, I have a soft spot for people and families and all of that. And I just think 2025 could be worse than anybody's expecting. Now, for the good side, that's going to mean opportunities. It's going to mean the people that do the work find motivated sellers. It means we're going to be able to buy deals from banks, perhaps. It's an environment where there is debt blowing up deals. There's going to be opportunities to buy assets at discounts. So again, assuming you set yourself up, you have your emergency fund, you're skilling up, you have, you do the right things. It could be an amazing time for my community because we do the work. We're not afraid to write lots of offers. But we see it all the time, right? The average American doesn't have this or that. So there's going to be a lot of people in bad shape. The people that do the work, that have reserves, it could be an amazing time to buy assets, but that just means at the expense of others. So that's my fear for 2025.
So I see the question a lot, what's going to happen with the market? How's the interest rates going to impact it? How is housing going to impact it? Affordability, the election. And I want to make sure that Dale understands I'm trying to answer in a way that will help you. It's not intended to attack you. Okay. Because I understand the question. And I like to watch the One Rental at a Time daily financial news update because you can actually learn things that can change the trajectory of your life. In 2020, with everything going on, I was just like everybody else thinking, oh, who knows what's going to happen? There's an eviction moratorium. Maybe we just sit back a little bit. And then you were talking about how interest rates had plummeted. I wasn't even watching what was going on with interest rates. And then I look and I was like, wow, some of these deals make sense at higher prices. And I bought emptied my retirement account, bought a triplex that's made me hundreds of thousands in the last few years because I watched the news. So thank you for that. So that was what was happening that day, though, like currently. When someone says what's happening in 2025, this is why I wanted to say, Dale, I'm not trying to attack you. I'm trying to help you. I couldn't care less. I've never thought what's happening in 6 months, what's happening in a year, what's happening with interest rates, what's happening with the market. There's two things that tell me when to buy. It's not the market. So I invest planning on rents going down, right? I've diversified my tenant base. I'm spread out in several different areas next to several different economic drivers. I keep my cash flow at such a point where rents could go down 50%. And I still don't have to go back to work. But I'm planning for all these bad things to happen. But when I buy a property, I don't think I'm going to buy this because if there was a crash next year, I would still buy. If I knew there was a crash coming next year, I would still buy. If prices were going to go up next year, I would still buy. The two things that tell me when to buy, no matter what I think is going to happen with the market. That's why I kind of dismissed the thought. Mm-hmm. First, am I ready? And Dale, are you ready? Not meaning, do you have the down payment, closing costs, money for immediate repairs? Have you studied your market? Do you know your asset class? Like all that has to happen. But do you have anything major going on in your life that's taking away your mental bandwidth to focus and get a good deal? Like birth, death, divorce, change of careers, like serious health concern. If there's those things going on, it's not the time to be buying a rental property. It's time to take care of those life events. But if you don't have these major things going on and you've got everything else ready, then you're ready. The second thing is, did you find a great deal? And if you find a great deal, that means there's enough margin to where if there's a crash or rents come down, you're still not going to be losing money. But we're planning with a buffer. We're not over leveraging. We're not going 105% loan to value with an adjustable rate loan like 2007 all over again. We're going a good down payment, fixed rate debt, conservative numbers. So when someone says, what do I think is going to happen with the market in 2025? I don't care. I don't think about it. I do watch the news to go, okay, what's going on today? What is Zuber talking about that's going on today? And there are some predictions that we go over, and we see a bunch of people predicting what's going to happen with housing in the next year and whatever we've done. And I don't see too many videos where they go, let's look up 2021. What did these major callers call, whatever the major media sources are, and what was going to happen with housing and what actually happened. So nobody really cares how accurate they are. And so I think people are looking for a reason to take action or an excuse to be sedentary. And for me, it's those two things. I'm not ready to buy. I don't want to because I'm enjoying the retirement and I'm not, but if a great deal pops up, I'll probably buy it because I'm also ready. I'm just not hunting. Right. So that's how I look at it, Dale. It's not so much what's going on with the market, but are you experiencing those two things that tell you to buy or not buy?
I love it. And again, I just realized that this whole chat section has comments from both our channels in it. So I think mine's the little red button and yours is the gray ones, at least on my side. So that's kind of cool. I didn't know that worked. So nice.
We'll have to try it with Matt next time and see if we can get all three going and see.
Absolutely. Yeah, we can plan for that. Wednesday, 8 a.m. Pacific. We'll do another live. Actually, you know what? I will take an action item and make that happen. You're going to get another live stream with the three amigos on Wednesday at 8 a.m. I will try to get that scheduled. So yeah, so far I'm liking StreamYard. The opening was a little rough because I don't know about the delays, but I'm sure I can get better at that. Here's a question I thought would be fun to talk about. I've saved up 3 months of reserves first, but don't have my first rental yet. Should my next move be to learn what a good deal is and keep increasing my active income? I'll let you go first on this one.
So I talk often about the 6 steps to reach financial freedom through real estate. And the first step is to learn how to save. And most people, when they hear save, they think spend less. No, it's increased income. So no matter what point you are at your real estate investing career, until you hit I've won the game, I'm going to stop playing and retire. I think increasing active income is one of the biggest contributions you can make to your chance for success. Right. So don't stop that. Right. Yeah. Saving up reserves is a good start because you need reserves, then down payment, then costs for immediate repairs. You're going to have expenses when you close on a property. So we're also continuing to save there. But to take a page right out of one rental at a time, this is why you're still studying the market, learning what a good deal is, and because you're not going to see a good deal if you're not doing that, while you're building your down payment, while you're building your money for immediate repairs, while you're increasing your active income, which could be side hustle, could be overtime, could be changing careers, could be changing companies. Like there's all these steps we could take to increase income, but also learning the market. And I think one of the mistakes a lot of people do is I work a lot, so on Saturday I'm going to spend 5 hours and learn my market. I think that's a mistake. I mean, you've talked about it many times. Take 15, 20 minutes a day, every day, to watch deals that come in. Not every agent thinks you always post on a Thursday because that gets you ready for no, it's just random deals that come up Tuesday night at 10 o'clock, and I'm under contract by Wednesday morning sometimes on properties.
Mm-hmm.
So be looking every day, learn your market, and be ready to change your opinion of your market. Right? Like Chester going, I found a single family house. Should I move to small multifamily? What if small multifamily don't work in the market you're learning? Right. I've got a friend who invested in a part of Ohio. She 1031'd to single family houses there from an area where single family houses don't work. So you have to adjust your strategy and your opinion based on the evidence you find, not the evidence you're looking for.
Yeah. I have nothing else to, I think that was very well said. I agree with all of that. Julie asked a question, which should be a lot of fun. Let's bring this one up. I love this little show comments thing. This is pretty cool, StreamYard. Nice job. Michael, you seem to have gotten more conservative over the last 5 years. Am I correct? So again, we got to be careful with today's political climate. I'm assuming you mean investing conservative versus politics. I'm going to assume that. And I think that's fair. I think what you've witnessed.
Coming from Julie, are you moved to Texas conservative?
Oh, wow. It's politics conservative. Well, I'm going to do the other one first.
Okay.
So again, I think it's fair to say what you guys have witnessed since I created One Rental at a Time, the YouTube channel, is I don't know if I would call it more conservative. I just think I would say I'm enjoying life more. Because if you go back to the first 1,000 videos, probably 100 of them were me documenting the 58 flips we did because I was bored, right? We did that from 2018 to early 2020. And that's when deals just stopped making sense. I couldn't buy slumlord properties, even from wholesalers. So I'm certain I will certainly take layups now. In the last couple of years, there's only been a few layups. I'm certainly not working as hard. I'm just you've seen a guy go from growth mode to maintenance mode in real time. That's what I hope you've witnessed. That's what I feel. Now, if you want to go on the politics side, no, I'm the same guy I've been all along. I just happen to have grown up in a state where my vote never mattered, right? Just didn't matter. I no longer live in that state, so now my vote matters. I'm somewhere, I don't know, 60, 40, 70, 30 on the landscape. I have voted some Democrats over time. But definitely lean Republican. But for most of my life, I don't know, I would say until I was 30, maybe 28, I don't know. That's what happens to kids. We just start out being Democrats. I don't know. But that's where I was certainly that way for my first 3 or 4 elections until I woke up and opened my eyes. So I don't think I've been more conservative over the last 5 years. I don't think. I don't know. That's my opinion. Dion, thoughts? I don't know.
Well, I think watching your content and my content in the first couple of years of having a channel, we were a lot more careful about saying anything left or right because we were kind of growing a channel.
Yep.
And I think once we realized we're not trying to grow a channel. Impact.
Yeah.
Right. We're trying to have impact on the people who watch the channel. So we might be, at least I'm a little more transparent on my beliefs. Now, I got kind of lucky, joined the Marine Corps, worked in law enforcement, and been a truck driver. And that's 3 careers where you don't vote Democrat.
Yeah.
They destroy you. They defund police. So why would you vote for that? They limit military and they limit military pay raises, benefits, and they create more regulations for transportation. So I've worked in 3 industries where I'm like, wow, there's Americans and then there's the enemy. Right. And so I say it on my channel. I'm very transparent about it. I have some friends I have a friend who's very so far left, doesn't own a firearm, freaked out that I probably have 2 on me every time we're ever interacting with each other. And absolute socialist, owns 30 rental properties. How do you mentally divide yourself from your beliefs to what actually works?
Well, maybe he doesn't charge rent. Maybe he doesn't charge rent.
He does keep his rents low, right? And he keeps saying, "Oh, I'm going to use that binder strategy someday," but not yet.
There you go. We did have a question earlier about sober living. I don't see it anymore. What are your thoughts on sober living? Again, I actually know a couple of guys in my community of Fresno. Again, that's what happens when you network and you get to meet more people. Again, one of the 7 ORaaT rules is meet 2 new people a week. And if you do that for a year, that's 100 new people. You do that for a decade, that's 1,000 new people. You get to know people that are trying lots of different things. They're wildly successful with sober living. It does take more regulations. You can triple net those properties, meaning lease them out to a sober living facility. As far as, would I go that direction? Too hard, too far, too different. Not in growth mode. So it's too different than anything that I've done. But there are people that are doing extremely well. Again, to me, it's all about focus. If that's what you want to do, you go learn that. You don't, I'm going to be a long-term, landlord for singles. And I'm going to also learn sober living. No, those are different. You don't divide your mind. You're going to go backwards. So focus.
So kind of like investing at a distance or doing a lot more rehabs or burrs or the different strategies, find the person in the community that's done it, figure out what worked for them. I mean, I say it's really simple. I just buy from the MLS. I buy cash flowing rental. I buy one every 2 years. But I have military, Section 8, working and retired. I have more than 10 miles apart. I have side-by-side units as a preference. I have pet-friendly fence yards. I have washer-dryer hookups inside. So even to just go, I buy rentals off the MLS and I do it the lazy way, there's a strategy to learn. So if you're going to do sober living, it's not ask me. Yes, it's probably something you can do successfully. It's not my strategy. I haven't looked into it and I haven't done it. But we need to find here's the person who is doing it. We've got the Millennial Mike, we've got the Lumberjack, we've got Ty, we've got all these people that we can go. Here's where you get the information from. Who's the sober living guy? Because I've seen this twice now. I've probably seen that question in the last month or so.
Yeah, there's Jared who runs our Sunday accountability group inside school. He does rent by room. That is something I'm hearing more and more people talk about. Rent by room is similar to sober living. Jared is also looking at least has spoken to me about sober living. So again, the beauty of the school community is it has all types of investors. You want to do short-term rentals? People in there. You want to do midterm? People in there. You want to do out of state? People in there. You want to flip? You want contractor? The beauty of the school community now at over 300 people or just under 300 people, soon to be over 300, is everybody's in there. And again, that's the beauty of keeping the price point where it is at $20 measly a month, 67 cents a day, folks, 67 cents a day, is you're going to be around people that are really doing it. We're not posers. We're really doing this. And the beauty of the group is there's some people ahead of you that can help and some people behind you that you can pull up. Then you get all the free goodies and all the, the calls with millionaires each week. I'm doing a live stream on Monday just for school. So again, if you haven't joined school yet, I don't know what you're doing. You need to join school. It's just one rental at a time. It's really easy. Dion, any kind of closing thoughts as we wrap up this first hour?
No, I appreciate you taking the time to do a live stream. Matt, the Lumberjack Landlord, does a live stream every week, Thursday, 6 p.m. Pacific. I do a live stream every Tuesday, 4 p.m. Pacific. And as many times as you want to, the Three Amigos meeting every Wednesday at 8 a.m. I absolutely would love to go live stream whenever you want to. I like making the videos, but I also like the live streams because, like I said at the very beginning of this video, what you get when you ask a question here is what do guys like Zuber and me and Matt keep in top of mind awareness to make quick decisions on buying a deal, passing on a deal, what market to choose, where we invest, how we invest, what strategy we chose, why we do it, what our end goal was, all that stuff that we think about that we don't have to research.
Yeah. And again, all 3 of us plus many, many more millionaires from the channel will be in Vegas February 15th and 16th. So buy your tickets, book your travel, save some money. Dion, you're amazing. Matt, look forward to doing this with you on Wednesday. Take care, everyone. Later.
Ciao.